Hello, welcome back. In this video we're going to have a stock battle. We're going to talk about Micron technology and the other competitor is going to be Nvidia. And so we're going to compare these two companies and see which one of the two makes sense to actually hold, which one is a better buy based on what they're doing financially and based on what the price is, because it's a combination of the two. We'll start off with Micron technology here. And the first thing to notice is that the company has been a high flyer. You will see that it has gone up a lot and it hasn't dropped a lot based on what the market has been doing lately. It still seems to be doing relatively well, because in the last month it dropped like 13%, where a lot of companies have actually dropped 40-50% in some cases. So that's interesting to see. The company seems to be holding up pretty well. Now, the outstanding shares of the company at 1.12 billion here, they are actually increased a little bit from what they used to be back in 2012. And that's a relatively high increase here. It's like what, 15, or no, probably 20 to 25% over here. So the company has been issuing some shares, taking advantage of the increasing stock price, I suppose. So the next thing is that the company has a dividend yield of 0.5% here, and I want to examine the actual dividend payout ratio here. And we will see that the payout ratio is negligible. It's sitting at 1.5%. So it's not even probably worth it even talking about it. So the next thing that we're going to examine is the income statement here. The interesting thing that you have to take a look at here is the fact that the company has actually been losing revenue in 2019 and 2020. And that's a steep decline, if you actually compare it to what was happening in the previous years. But lately, in 2021, it has actually increased again. I guess the need for semiconductors has been more and more, and that makes some sense. Now, the net income of the company is what we want to examine here, and you will see that this has been increasing very nicely. It only was really bad in 2020, and lost a lot as well in 2019, because previous year was 14 billion. Now, there may have been some sort of, one-time payments and things of that sort happening here, so that's why. So, regardless of that, you are seeing that the company seems to be increasing its net income in the past year, and that's obviously very important to see. So, and that matters a lot because of the recency. But the total liabilities, the total assets of the company first, they are actually also increasing. So it's nice to see a balance sheet, increasing in the total assets of the company. The total liabilities are sitting at 15 billion here, and the total equity at 46 almost billion. So that's also pretty awesome for the company. The cash flow of the company as well here is having a cash from operations that is also increasing. So we're seeing increasing operating cash flow. Cash from investing here, the company has been investing relatively heavily in capital expenditures. A lot of investing here going on within the company. So that's interesting to see. But this actually looks like it's sort of like typical expenses, not really investing in too many new things here, because they have been happening every year. So it looks like this is something that has been ongoing for a while. And it may be worthwhile to actually take a look internally and understand what kind of capital expenditures these are. The cash from financing here, as you can see, it is in the negative, which is a good thing, because the company has been paying back debt and also repurchasing common stock, as you'll see here. And in the last 12 months, there have been the actual highest. Oh, actually 2019 was pretty high as well. So they do deem the stock price to be relatively, underpriced, so undervalued. So maybe that's why they're buying. Now, the free cash flow of the company used to be 3.4 billion, and at some point this year, as we know, it was the odd one out. But last year, it had $2.4 billion in terms of its free cash flow. A lot of variance here, going up and down a lot. The multiples of the company, relatively fine here. Actually, pretty fine. Anything below 3 is more than fine. Profitability is fair, 17% return on equity here. The solvency ratings, tab ratios, 16% is very low. That's fine, totally fine, not much debt compared to equity. But let's now take a look at what the company is worth for us to buy today. So is it worth it to pay $79 per share? Let's take a look. And of course, we have the handy table here that can help us calculate an average. As you'll see, the 3-year average has been negative because of this couple of years. So we have to take this into account and be conservative with our generally used revenue growth here. So I'll have to go rather low. I'm gonna go 8, 9, and 10 here. Now, if the company was doing similar revenue growths here, or at least even 20% or maybe 15% here, I would have a higher revenue growth. But the fact that they have negative years here, actually prompts me to use these values, and that could also be confident in some situations. So the net income margin has been relatively steady here. So I'm gonna go with something like 18, 19, and 20. And the free cash flow margin again has been relatively the same. And so I'm gonna go, I always like to go a little bit lower. So let's go 35, 37, and 39 for this calculation. The annual return that I typically want to get is 13%, and we calculate and we see that the current price of the stock is actually expensive for what we want it to be. So our high estimates, it should be at around $40, 39 to 40, medium one $34, and low one $29. And we are currently sitting at $79. So it is expensive for what we'd want it to be in order to buy today, even for our highest estimates here. Now, I did go a little bit conservative, so if you think that the revenue growth of the next years is going to be more normal, maybe let's just say let's go 15, 17, and 19, which is likely what may end up happening really, then we're getting a little bit closer. We're still actually overpriced on the current price, even using this revenue growth, but it is a little bit better. Now for the next one, we're going to compare this to Nvidia, our next competitor here. So let me actually bring it up and I'll see you soon. Okay, so I fetched the data that I needed here for Nvidia. As you see, another company that has been a high flyer and also hasn't actually even lost much in the last month. But look at it from the previous months actually. It used to be 330 at some point. So it is down a little bit overall. But in the last year, it has gained 108%, so it has been a massive high flyer. And that's always a little bit of a potential, maybe negative for somebody who wants to enter right now, the fact that it has run up that much. But we're going to, as usual, be very, very objective here and see what the company has been doing. It's paying a little bit of a dividend yield. It's probably negligible, but we are going to check it. The outstanding shares here have also been growing, similar to Micron. The company has been taking advantage of the increasing prices, as you can understand. And we're going to take a look at the dividend here. I'm assuming it's going to be low. It's actually more than I expected, but it is 4%, so it's actually pretty negligible again. So that's not a concern. What about the income statement of the company? Let's see what they're doing financially. So again, you are seeing a company that has great revenues apart from 2020, which was a bad year for them. And so the net income of the company, let me find it here, it is actually increasing from 3 billion to 9.7 billion. So pretty nice, almost threefold increase from 2018. That's actually pretty great. Now the balance sheet of the company points at a company that's actually increasing its balance sheet tremendously well. Again, this is like quadruple what they used to have in 2018. So it's amazing growth over here. Total liabilities of $17.5 billion and a total equity of from 7 to 26.6. So again, we're having a company that's actually increasing more than Micron. So it seems to be having better growth. Now the cash flow of the company, cash from operations, also increasing nicely. Again, a threefold increase, which goes on par with what we have seen with the net income and pretty much the profit of the company has been generating. The cash from investing has been negative here because they have been investing mostly in marketable securities here, in market securities. So you see they have been heavily investing in the market. That's interesting. And cash from financing is positive here. I'm assuming they're getting some debt. Yes, long-term debt is issued here, 2 years in a row, quite some debt over here. And free cash flow of the company is pretty massive here, from 3 billion to 8 billion. Another almost threefold increase. Great to see for the company, doing very well. The multiples here are actually very, very high. So this is one of the first things that potentially points to a very, very overpriced company. Now, this doesn't mean that's a bad company. This has nothing to do with whether that's a good or a bad company. It has to do with the price of the stock. That's what we're examining. The profitability is better, way better than Micron, actually, as you can see, much better numbers. And the solvency here is a little bit more, but still within range. I'm not at all worried about this. And the next thing that I'm going to be examining is the same thing that I did earlier with Micron. We're going to go to our stock evaluation tool here and examine Nvidia. And as you see, we have again some 1 year actually that was bad for Nvidia, but for the most part they have been crashing it. Now this year will affect me a little bit, but not as much as was affected by Micron, because it's typically speaking the company is doing much better, and it hasn't happened for like 2 years, of course, and it wasn't that great of a loss because Micron had like 20% or something. So of course I'm not gonna go that high, but I'm gonna go 15, 18 and 21 for my projections here. The net income margins, you can see here that they are also very typical and similar here. I'm gonna go 25, 28 and 32. And the free cash flow margin, again, you kind of want to see a company that has similar margins. That's a good thing to see because it's more predictable. And then we can use something like 80, 90 and 100 and a 13% annual return here. And I'm going to hit calculate. And you'll see that again, we're having a company that is overpriced. The stock is very expensive based on what the company is doing. It's actually more expensive than Micron. And so even if, again, if I added more revenue growth here and I went a little bit overboard, maybe 28 even, let's recalculate, and you will see that again we are very far from what we'd want to get the company for. So that's the whole point here, to actually understand whether it's worth it to buy one or the other. So when I'm looking at these two companies, Micron and Nvidia, I'm not buying any of those, and I love the companies. I think that both of them are great companies. I like what I'm seeing from Nvidia more than what I'm seeing from Micron, but I do like both. However, I would like to get them at a discount, and Micron at a higher discount, because Nvidia has better financials and better growth. I'd love to get both of those companies, but for much lower valuation, lower price here. And so at their current price, I'm just not a buyer of any of those companies. If I definitely had to buy a company of the two, I would probably go with Micron, just because it's less expensive. But I do understand that Nvidia has more potential. That's another thing. But I just don't like overpaying. So again, I'm not a buyer of any of the two, but if I really had to buy one at these prices, I would probably pick Micron. So I hope you enjoyed the video and it helped you a little bit with your investing decisions. And if you did like it, please leave a like, that really helps, and subscribe if you're not a subscriber already. And if you enjoy this type of content, you may want to take a look at this video that I made earlier. And I'm discussing a few things about companies and stocks, which I think you may be finding interesting. And so it may be worthwhile to take the time to watch the video to understand a few things about investing if you're new to this. So thank you for watching this video, and I'll see you soon. Bye bye.